What about risk? How do you assess risk? If we're now saying, oh, put your money in, let it ride, add to it over time, start with 15,000, you find yourself 40 years later, you're going to have $900,000 or something approximating that, depending on how the overall market does in the next 40 years. But what about larger risks? What risk could reasonably threaten that in the next 40 years? Or are you telling your grandchildren in their 20s now, just go with this game plan?
Well, I do for my grandchildren. They can change it when they get there. They don't really know how much money I put away for them over all these years. And I've always put it in balanced index fund. 60% S&P 500, or total stock market, I should say, and 60% total bond market.
60 and 40. You said last time we talked that anyone watching could put all of their money into that one fund and make it their sole investment throughout life.
Now, it's conservative, and it protects you against your emotions, because when the market goes way down, stock market goes way down, the bond market actually usually goes up a little bit under that circumstance. So investors have behavioral problems, and they panic if their account goes down 50%. An account like this probably goes down 32 or 3%. Okay. So you don't get exposed to the worst of it. There's no question that a 100% stock portfolio will do better in the long run. I mean, that's just the numbers. Stocks will return over the long run, not every 25-year period, but probably 3 out of 4. Stocks will return more than bonds. They will be the highest returning investment because they have a higher risk. Now, what is risk? Let me tell you what it is not. It is not volatility. We use volatility to measure risk. You know, if the market goes up, let me say, or down 25%, and you own the market, that's what you do. If you want to reduce the volatility in a balanced fund, you know, you maybe go up or down 15%. And if you want to get an extremely aggressive fund, maybe up and down 40%. But it's symmetrical and fairly symmetrical. And so that's a way of measuring, but it's a short-term thing. In the long term, the risk is that you may lose one hell of a lot of money. If you started buying stocks in 1919 or 1920 or 1918, you were doing fine through 1929, and then you lost 90% of your money in an all-stock portfolio.
And it took you another 15 years to get back to even or something.
Yeah, actually a little more. Just about right, 15 years in mid-40s. And so those kind of risks are big risks. And they're risks that we can't measure. There are risks that come from things like, what is the probability that our society will collapse? What is the probability that with all the undercurrents that are going on in American society between the haves and have-nots, and the haves, the superior, larger races and the minorities, those gaps are very wide, and I'm deeply concerned that we may get in some real trouble, and that's why I describe myself as so conservative that I'm liberal. I want to protect our society, and therefore I want to protect those segments of society that haven't been treated fairly to the best of our ability. And then there are the known risks, like nuclear war, worldwide disease, plague kind of thing, religious uprisings, the things that we know about and worry about today. And then, as my fellow Princetonian Secretary of Defense Donald Rumsfeld says, those are the known unknowns. And what about the unknown unknowns? And of course, since they're unknown, we can't comment on about that.
But none of those unknown unknowns, or none of those big risks, cause you to change your investment approach, I guess, because the assumption is if the market goes down 90% on the Bogle family portfolios, that there are so many other problems in the world, it's probably not going to be a make or break thing for you that your stock portfolio is down.
Well, no, as a wise man once said, if there's nuclear war, it won't matter a hell of a lot whether you own stocks or bonds. It's gone. Society is gone. It's frightening to think about. And I think that given the enormity of these kind of risks that I've described and the unknown risks that we really don't know, we don't know what they are, which is kind of frightening. But invest you must. As I've said to people, probably on television or interviews kind of thing, the one way to assure that the value of your retirement plan is zero is to not invest a penny. and 0 is guaranteed. So you have to put your money to work. In the extreme circumstance, even cash is not going to help you. It's not going to be any good if the nuclear bombs start going off. It's a frightening, fragile world that we live in. So you can sit and worry about it every day. And, in certain respects, if you like to worry, it's a good thing to worry about. But you kind of have to get on with your game, prepare for the future, and hope that those extreme risks don't come home to roost.